Let's look at some more examples using the T account to illustrate the debit and credits concept. This slide shows the entry of a $50,000 long-term loan taken by a business, with the proceeds being deposited into the cash ledger. Again, a debit entry increases the balance of the cash account, and the credit entry increases the balance of the liability account, which in this case is notes payable. Continuing this example, we see that the company uses $30,000 of these loan proceeds to purchase equipment. The reduction to cash comes from a credit entry, and the debit entry increases the balance of the equipment ledger, accounting for the new equipment. Remember, cash is an asset, as is equipment. A credit entry reduces an asset item, and a debit entry increases an asset item. Here's one more example for this company. In this slide, the business needs to purchase a $20,000 truck and will do so by placing a $2,000 cash down payment and financing the remaining $18,000 balance. The vehicle ledger is debited by the full value of the vehicle, in this case $20,000. As a vehicle is an asset, this account must be debited to increase its balance. The $2,000 down payment reduces the cash ledger, and this is accomplished with the credit entry. The additional loan is accounted for with a credit entry to notes payable. Remember, a credit entry increases a liability account. An in-depth look at financial statements can be found in the Understanding Your Business Financial Statements course, but now we will take a quick look at two financial statements used on accounting, starting with the balance sheet. The balance sheet is a financial snapshot of a business at a specific time. This is similar to your personal bank account ledger. When you look at your balance, you see it at that moment. The balance sheet tells us the balance of all asset, liability, and equity balances of the business. The balance sheet gets its information from the type of ledger entries we made earlier in this class. As you can guess from its name, the balance sheet must balance by using the basic accounting equation. Assets must equal liabilities plus equity. If this does not hold true, there are accounting errors that must be corrected. Here's a sample of a balance sheet from an actual business. Please pause the presentation and take a moment to look it over and review its format. The assets section of the balance sheet can be broken down into two types of assets. Current assets are assets that can be converted to cash within 1 year. Some examples are listed on the slide. The next type of assets are fixed assets, and these are things the company owns that are more permanent or long-term in nature. Liabilities are also classified as short and long-term. Current liabilities are obligations of a company that are due within 1 year. These are short-term in nature, such as accounts payable. Long-term liabilities are longer-term and are paid in full in more than a year. Examples of long-term liabilities are mortgages and other long-term debt. Equity is the net worth of a company. It is the difference between the assets and liabilities. Let's create a hypothetical balance sheet using the following scenario as a guide. You have sold $1,000 worth of merchandise and placed this into your cash account. We will also consider this the net income of your business. You own equipment worth $10,000 and have a loan against it of $8,500. Your building is valued at $250,000 and your current mortgage balance is $123,000. This is the complete balance sheet from the previous example. Here you can see in current assets, we have the $1,000 cash. Fixed assets include the equipment, the building, for a total of $260,000 for fixed assets, with total assets equaling $261,000. In liabilities, we listed no current liabilities as there were none given in the example. For long-term liabilities, however, we have the equipment loan, the building loan, which left total long-term liabilities of $131,500, which is also the same as total liabilities of $131,500. The equity we have in this business is $128,500, and then we also have to add in the $1,000 of net income, which brings total equity to $129,500. So total liabilities and equity equals $261,000, which is also the same as you can see with total assets. So in this example, the balance sheet does balance and was completed correctly. Unlike the balance sheet, the profit and loss or income statement covers a period of time. This can be any period of time you choose to track, such as annually, quarterly, and so on. This financial statement shows the net income of a business after looking at all sales and expenses of the business. Here is an example of an income statement from an actual business. Again, feel free to pause the course and take a moment to review this statement. The income statement tells us a lot about the financial transactions that take place in a business. Sales show us the revenue gained from business activities. Cost of goods sold are the costs incurred to have items available for sale. For example, let's say that a retailer sells televisions and he has to order his televisions from a supplier. The cost that his supplier charges him is his cost of goods sold for those televisions. The difference between the sales price and the cost of goods sold is the gross profit of selling an item. Using the television example, if a television could be sold for $500 and the retailer pays $300 to purchase a television from a supplier, the gross profit would be $200. The expense section of the profit and loss statement outlines all the expenses incurred when doing business. When we subtract all of these expenses from the gross profit, this leaves us with the net income of the business. This concludes this presentation. Again, a more in-depth look at financial statements can be found in the Understanding Your Business Financial Statements course. Please continue with the remainder of the online class, and as always, if you have additional questions or comments, please post them in the question forum. Thank you.